Today, we're tackling a really interesting puzzle. You've got Visa and Mastercard, whose businesses are absolutely on fire, but for some reason, their stocks are falling behind. So, is this a hidden opportunity for investors?
All right, let's dive right into the central mystery here. There's this massive disconnect between how these companies are actually performing day to day and how the market is treating their stocks. It's a total head-scratcher, and that's what we're here to unpack.
And look at this. This chart just spells it out perfectly. I mean, you see this bar here? That's business growth. We're talking fantastic double-digit numbers. Then you look right next to it, and yikes, that's the stock performance, deep in the red. It's like they're living in two completely different worlds.
Okay, section 1. Let's really dig into the numbers behind this whole strong business, weak stock paradox.
So the numbers here really do tell the tale. Both of these giants recently blew past what all the experts on Wall Street expected thanks to really strong consumer spending. We're talking 12% top-line growth for Visa, and get this, a whopping 17% for Mastercard. And yet, look at their stock returns. Over the last year, they've actually lagged behind the broader market. How does that even happen?
So, you gotta ask, right? Is this just a temporary dip, or is something fundamentally wrong? Well, to get a handle on that, we really need to understand their business model. And honestly, it's so simple, it's brilliant.
And if you want proof of how tough these businesses are, just look at this quote. Think back to the 2008 financial crisis, the Great Recession. The entire market, the S&P 500, was in an absolute free fall, down about 55%. And Mastercard? It barely flinched, dropping just 12%. That tells you everything you need to know about their stability.
So what's the secret sauce here? Well, think of them as the ultimate toll booth operators. They've set up shop on this massive global highway of commerce, and every single time you pay for something with your card, for a coffee, for groceries, for anything, they're there taking a tiny, tiny little slice of that transaction.
And here's where the magic really happens. That little slice might seem like nothing, right? Just pennies. But you multiply that by the billions and billions of transactions happening all over the world every single day, and suddenly these companies transform into these unbelievable, high-margin, cash-generating machines. It's all about that massive volume.
So now for the main event, Visa versus Mastercard. Let's put these two heavyweights in the ring and see how they really stack up head-to-head.
First up is market share. When it comes to sheer size and the number of transactions they handle, Visa is, without a doubt, the king of the hill. They're the bigger player by a pretty wide margin. But Mastercard is the scrappy one, growing just a little bit faster trying to close that gap. It's a slow race, but they are gaining.
Now, let's talk about profitability, because this is where things get kind of crazy. I mean, look at these operating margins. Visa is sitting at around 67%, Mastercard at 59%. To put that in perspective, a lot of great companies would be absolutely thrilled to have margins in the teens. This just shows how incredibly efficient that toll booth model really is.
And when you look under the hood at their financial health, wow, these things are built like tanks. We're talking fortress-like balance sheets, consistently growing their dividends in the double digits year after year. And the return they get on the money they invest back into the business, it's just phenomenal.
Okay, so all of this brings us back to the million-dollar question. Are these stocks actually on sale? Let's dive into the valuation and see if we can find some clues.
So our first clue comes from a metric called the forward price-to-earnings ratio. It's just a common way to see if a stock is cheap or expensive. And for Visa, right now, that number is sitting right around 25.5.
Now, why does that 25.5 number matter? Well, here's the kicker. It's actually trading at a discount compared to its own 5-year average. You know, for a top-tier blue-chip company like Visa, seeing a signal like that it might be undervalued, that doesn't happen every day.
Okay, now let's look at Mastercard. The story is pretty similar, actually. Its forward PE is a little bit higher, coming in around 29.2.
And guess what? Just like Visa, that's below its 5-year average, which was closer to 32.5. So we're seeing the exact same pattern here. It reinforces that same signal that the market is valuing it more cheaply today than it has, on average, for the last 5 years.
So the big takeaway from all this valuation stuff is pretty clear. The source analysis is basically saying that, based on their own history, these are premium, top-shelf companies that you rarely get a chance to buy at this kind of a discount.
All right, last section. Given all this, what could these companies actually be worth down the road? Let's check out a model from the Analyst that tries to project a price target out to 2026. So,
The analysis uses a pretty standard valuation method called a discounted cash flow, or DCF. It sounds complicated, but the idea is simple. You basically try to figure out what a company is worth today by adding up all the cash you expect it to make in the future. It's all about what's coming down the pipe. And when you run the numbers, well, the results are pretty telling. Even using some conservative assumptions about growth, the model points to a potential 32% upside for Visa by 2026, and for Mastercard, a potential 9% upside from where it's trading today.
But here's where it gets really fascinating. You can flip this model on its head and do what's called a reverse DCF. Instead of asking what the price should be, you ask, what kind of growth is today's stock price already baking in? And for Visa, the market seems to be expecting only about 5.5% growth. That's way below its history. For Mastercard, the market is expecting a much healthier 10.7%. So there's a real difference in expectations.
And it's not just this one analysis that's bullish. If you look at Wall Street, the pros seem to agree. Their consensus price targets are pointing to a potential 24% upside for Visa and a 28% upside for Mastercard just over the next year or so.
And so, we end up right back where we started, with this really compelling puzzle. Are we just looking at a temporary slump for two absolutely unstoppable giants in the financial world? Or is this a genuine bargain that's just hiding in plain sight? The analysis we've walked through certainly suggests the market might be sleeping on these powerhouses, which leaves a big question for you to chew on.